clients, welcome to PhillipCapital's weekly market watch. My name is Nicholas, investment analyst from Phillip Securities Research. This week, we will be talking about Ezion Holdings. Ezion was engaged in the mechanical engineering business before 2007 and was called Analyst Technologies before they entered the offshore and marine industry. It started as an offshore logistics and service provider by offering support vessels to oil companies on charter. In 2008, it ventured into the self-elevating units SEU business, also called lift boats, bringing the concept to Asia and the Middle East. So what are lift boats? Lift boats are mainly used as stable work platforms to perform a range of services such as repairs and maintenance of production platforms, oil intervention activities, etc. They can also reposition itself at an offshore site and move to new location without any assistance, unlike the jackup rigs and barges. Hence, its higher efficiency and ability to work in tougher conditions make it increasingly a preferred option. Lift boats are used mostly in the Gulf of Mexico, while there are 250 SEUs in North America to support 3,300 plus offshore platforms. There are only 62 SEUs in Southeast Asia, Middle East, and West Africa combined to support similar amount of platforms. We believe as oil companies outside US Gulf of Mexico begin to realize the advantages of lift boats as a low-cost alternative for offshore support functions, the demand for lift boats in Southeast Asia and the Middle East will continue to grow going forward, hence benefiting Ezion. As an operator of SEUs, Ezion takes contracts from oil companies, outsources SEU construction to the yards, arranges financing, and then leases out the SEU to the oil companies on a day rate basis. Ezion targets a minimum of 30% ROE for its SEU contracts. Although the majority of its charter contracts are concentrated in Southeast Asia and Central America, it is also increasing its presence in Middle East as well as other parts of Asia, providing it exposure to different geographic locations. With a total value of about 2.5 billion worth of contract spread over an average of 3 to 5 years, this provides long-term earnings visibility to the company. We estimate that Ezion will enjoy 68% two-year earnings CAGR driven by expanding SEU fleet and higher growth in offshore logistics business. Ezion currently has 12 SEUs operating on the long-term contracts, with another 11 units kicking in for the rest of 2013, 2 in 2014, and another 2 in 2015. We believe this will significantly drive Ezion's EPS over the next 2 years. As for its offshore logistics business, we expect higher revenue for this segment as its 3 LNG projects in Australia begin work in second half of last year and first half of this year. In conclusion, we believe that Ezion is well positioned to benefit from the robust lift boat demand in Southeast Asia and the Middle East. Its high ROE business model with $2.5 billion of SEU charters provides earnings visibility up to year 2020. Last but not least, this will translate to high earnings growth at 68% CAGR over the next 2 years. We value Ezion at $271 per share based on sum of the parts valuation. It is currently trading at its long-term average of 10.1 PE. That's all we have today. Do refer to our report on Ezion published on 5th of August should you want to know more about this company. Do stay tuned to next week's video. Thank you.